Welcome to the Deep Dive, where we cut through the noise and give you the essential insights from the information you care about. If you're looking for a shortcut to being truly well-informed without getting bogged down in endless reports, you're absolutely in the right place. Before we jump into today's deep dive, remember to hit that like button, leave us a comment with your thoughts or questions, and subscribe to our YouTube channel so you never miss out on our future discussions. Today, we're taking a closer look at Velesto Energy, or Valesto. They're a significant player in the oil and gas services sector, and they've just put out their Q2 FY2025 report. So we've gathered up all the essential sources, the financial statements, the latest industry analyses, and some insights into their strategic moves. Our mission today is pretty clear. We're going to unpack Valesto's current performance, try to understand where they're headed, and pinpoint the key factors that could impact you, the investor. We'll compare trends, check those crucial financial benchmarks, and look for those aha moments that, genuinely make a difference.
It is going to be a fascinating deep dive, I think. Valesto truly presents a mixed financial picture right now. They have some very clear strategic strengths, which we'll definitely explore, but also some equally clear operational challenges. Our goal is to connect all these dots, show how their past journey has shaped their present, and crucially, what it means for their future trajectory.
Okay, let's unpack this with a bit of history then, because Valesto has quite a story. They were originally known as UMW, Oil and Gas Corp Bhd, right?
That's right.
And they listed right during the oil boom back in 2013. Must have felt like riding a wave.
Oh, absolutely. They truly were a market darling back then. Shares soared. I think they hit as high as RM 4.58 in 2014. Market cap reached a staggering RM 9.9 billion. But then came the sudden crude oil routes starting late 2014, and it hit them hard, really hard. It was a real shock, especially because their 8th drilling rig, a huge investment, was delivered right into the teeth of that downturn in 2015. Talk about bad timing.
Oof. Talk about hitting a speed bump just as you're accelerating. Delivering your 8th rig right into that downturn. That must have felt like a real gut punch.
Yeah.
How did they possibly navigate that period?
Well, it forced them to make some tough, but, ultimately very smart decisions. They went through a massive recapitalization exercise in 2017. Permadala National Bhd, PNB, the big Malaysian investment institution they stepped in, injected RM 800 million through rights and preference shares.
Right.
And then UMW Holdings demerged its 57% stake. The proceeds from that went straight into paring down a huge RM 1.5 billion in debt. And this commitment to aggressive debt reduction, it's been a consistent theme for them. Borrowing shrank from, RM 3.77 billion end of FY 2016
Huge number.
to a remarkably lean RM 116 million by mid-2025. Yeah. That's a massive reduction, over 95%, fundamentally changed their stability.
That's an impressive turnaround on their balance sheet.
Yeah.
Beyond just paring down debt, what other strategic financial moves did they make? I remember hearing about some significant capital reduction efforts. What was the thinking there, and what impact did they have?
Yeah, those capital reduction exercises were absolutely crucial. They've done two significant ones. One back in February 2020 for RM 2.21 billion, and a second RM 1.2 billion exercise just completed August 14th, 2025. These aren't just, accounting removers. They optimize the balance sheet. They effectively erase accumulated losses, puts the company on a much better footing for future strategic moves.
Yep.
M&A, maybe, or just a cleaner structure.
Right.
And critically, from your perspective as a shareholder, these exercises directly make it easier for dividends to be paid out from distributable reserves.
Okay, so after all that restructuring, what does Valesto actually do today? What are their core operations?
Valesto holds a pretty unique position. They're the sole and largest rig service provider in Malaysia. They own and operate 6 jackup drilling rigs and 2 hydraulic workover units, so their main service. Drilling. For exploration, development, production wells. Beyond that, they offer integrated workover operations that's basically maintenance and enhancement for existing wells, and specialized services like threading, inspection, repair for OCTG, oil country tubular goods.
Gotcha, the specialized pipes and tools.
Exactly. High-strength stuff for drilling.
Okay, so their business is deeply tied to oil and gas, obviously. But I hear there's an interesting dynamic about their sensitivity to, fluctuating oil prices. Can you shed some light on that?
Yeah, it's a key insight, actually. While they're definitely in the O&G sector, their business is considered not super sensitive to oil prices. If we connect this to the bigger picture, it means their major clients, think Petronas, they consistently need their drilling and workover services, rain or shine, right? These are often long-term contracts for essential operations. So this relatively consistent demand base insulates them somewhat from those wild swings in the oil market, swings that might hit, say, an exploration company much harder.
Okay, here's where it gets really interesting for anyone holding Velesto shares or thinking about it. Let's pivot to a key player. Promotalin National Bhd, PNB. How does their significant stake in Velesto actually shape the company's direction? And what does that mean for you, the minority shareholder?
Right, PNB, the Valesto's largest shareholder, holding a substantial 48% stake, directly and through their unit trusts. This relationship is crucial. PNB, as you probably know, has its own unit holders who expect consistent dividends.
Right.
So this creates a strong, let's call it institutional encouragement for Valesto to prioritize and pay out more dividends. It's a direct benefit for all shareholders, really, because it means more of the company's earnings get distributed. And PNB has publicly backed Valesto's plans for enhanced sustainable shareholders' returns. That's a pretty clear signal, wouldn't you say?
Definitely sounds like it. And that level of influence, it probably extends beyond just dividend policy, doesn't it?
Yep.
We've heard persistent talk about PNB potentially privatizing Velesto.
Yeah.
What's the latest on that chatter?
That's correct. The whispers are indeed getting louder. PNB is exploring options to privatize Velesto, particularly, against this challenging backdrop for the wider oil and gas industry. What's fascinating is this isn't their first attempt, really. They previously looked at selling their stake, but apparently found limited appetite among other local O&G companies for such a large acquisition.
Interesting.
Yeah, sources now suggest that a privatization could be timely. Given Valesto's recent significant debt reduction, and that just completed RM 1.2 billion capital reduction exercise, these moves have dramatically optimized the balance sheet, making future strategic moves like a privatization much cleaner, much easier to execute.
So what does this all mean for you, the existing shareholder, if a privatization offer does come forward?
Well, this raises an important question about your exit options, doesn't it? Sources indicate the price tag for the privatization may not be exciting for other shareholders, especially since Valesto's share price has been pretty subdued over the past year, closing almost flat at 20 cents.
Not exactly thrilling.
Right. It means other shareholders may be reluctant to accept the proposed pricing. So for you, it becomes a forced choice, really. You'd have to weigh the potential for future bumper dividends, which are forecasted at an impressive 12.5% yield for FY2025, maybe 3 cents per share in 26.47. Weigh that against a one-time cash offer that might not fully reflect the company's long-term value, especially after that financial cleanup.
So uncertainty and potentially an involuntary exit.
Exactly. And maybe at a price that leaves you feeling a bit shortchanged.
Okay, let's dive deeper into the numbers then. The Q2 FY 2025 report and the trends leading up to it. They paint a critical picture of Valesto's financial health.
Indeed. The operational performance in particular shows a significant shift. The rig utilization rate, a really crucial metric in this industry, saw a dramatic decrease, plummeted from a high of 98% in Q2 FY 2024.
98%.
Down to a mere 57% in Q2 FY 2025. And for the first 6 months of FY 2025, it dropped to 62% from 96% the prior year. This sharp decline is primarily attributed to the completion of the IRDC project back in October 2024, and just generally lower demand for their rigs right now.
That's a huge drop in utilization, 57%. How are they managing to navigate such a significant operational challenge?
It's a crucial question, and it highlights a key dynamic. While utilization plummeted, we're seeing them command higher average daily charter rates, or ADCR. Those rates actually rose to USD 123,000 per day in Q2 FY 2025, from USD 115,000 per day in Q2 FY 2024.
Okay, so they have some pricing power.
Exactly. That pricing power provides a vital offset, partially mitigating the impact of these underutilized assets. And for context, globally, jackup rig utilization is actually projected to soften a bit to around 81% for 2025. So Velesto's situation isn't entirely isolated. On a positive note, they still have a robust order book, RM 1.2 billion, ensuring operations until 2028.
That's good visibility.
Definitely. And they are actively bidding for new jobs worth an impressive RM 4.3 billion. We also see capital commitments decreasing, reflecting very disciplined spending, down to about RM 168 million from RM 226 million a year ago.
So with those operational shifts, lower utilization but higher rates, how did this actually impact their top and bottom lines, their overall profitability?
Well, profitability has definitely suffered this quarter. Revenue saw a sharp decline. Q2 FY 2025 revenue was just under RM 200 million. That's a substantial 49% drop from nearly RM 400 million a year earlier.
Almost halved.
Pretty much. For the first 6 months of FY 2025, revenue decreased to RM 424.6 million from RM 732.0 million. Net profit also fell. Q2 FY2025 showed RM 50.4 million, nearly a 20% drop from RM 62.8 million. And earnings per share, EPS, naturally followed this downward trend for both Q2 and the 6-month period.
Interestingly, though, while Q2 numbers look challenging, the Q1 results for PBT profit before tax and net profit actually saw a slight increase compared to the previous year. How do we make sense of that mixed signal?
Yeah, that Q1 increase was mainly due to lower finance costs and depreciation, despite the lower rig utilization overall in that period. So it shows some internal cost management was, offsetting those operational headwinds during that specific quarter.
Okay.
However, the overall 6-month picture for 2025 still reflects a clear decline in both PBT and net profit compared to 2024, indicating that the challenges are definitely persistent.
And what about their financial strength? Solvency, liquidity. We heard about the significant debt reduction earlier. Is that still holding true?
Yes, the substantial debt reduction remains a major strength, a real testament to their financial discipline. Total liabilities decreased from about RM 500 million end of FY 2024 down to RM 338 million by June 30th, 2025, primarily due to lower trade payables and borrowing repayments. However, and this is where we see a concerning trend, cash and bank balances have actually decreased over the first half of 2025. Yeah, and there was a negative net movement in cash and cash equivalents. About RM 99.6 million for the 6 months ended June 30, 2025. This is a significant shift from the positive RM 85 million in the same period of 2024.
That's a big swing. Raises questions about cash burn.
Exactly. It raises an important question about their current cash burn rate. Our analysis of free cash flow also shows a decrease, down from about RM 126 million in the first half of 24 to roughly RM 85 million in the first half of 25. They also reported negative foreign currency translation adjustments, contributing to a total comprehensive loss for the period. So while debt is weighed down, which is great, the cash flow picture is definitely tightening.
Okay, every company needs its core strengths, its economic moat, as they say. So what exactly is Valesto's secret sauce? What gives them that competitive edge? And conversely, where are its vulnerabilities?
It really comes down to a few strong economic moats, I think.
Yeah.
First, think about getting into the rig business. It requires a truly colossal amount of capital, right? It's not a market for the faint of heart or light wallets, especially now when the market isn't exactly booming. So high barriers to entry, that's one. Beyond that, their market dominance in Malaysia, being the sole and largest rig service provider. That grants them significant pricing power and makes it incredibly difficult for clients to just switch providers.
Switching
costs.
Right, sticky customers.
Exactly. Then there's that degree of stable demand we touched on. Their business isn't super sensitive to oil prices because major clients need consistent services, rain or shine. And despite the lower utilization we discussed, they've shown that remarkable ability to command higher average daily charter rates, demonstrates clear pricing power. Finally, that robust long-term order book, revenue visibility until 2028. That provides a crucial buffer. However, they're not without weaknesses, of course. The inherent cyclicality of the O&G industry is a fundamental, unavoidable vulnerability. Always there. That significant decrease in rig utilization we just discussed, that's a major operational challenge right now. Also, while a cautious approach to reinvestment frees up cash now, which shareholders like, it could lead to an aging asset base long-term, potentially eroding their competitive edge against more modern rigs down the line.
Need to keep the fleet up to date.
Precisely. The broader market softening, oil price volatility, those remain background risks. And even in their dominant Malaysian market, there's always potential for clients to defer projects if things get really tight.
So with these strengths and weaknesses in mind, what's management's direction for the next, say, 5 years or so? And how are they navigating these tough times you've outlined?
Their direction seems firmly centered on maximizing shareholder returns, primarily through continuous financial strengthening and highly disciplined operational management rather than embarking on aggressive expansion.
Focus on the core, focus on returns.
Exactly. This strategy involves leveraging their already low debt, using those capital reduction exercises to pave the way for future strategic moves like M&A, and critically, maintaining strong dividend commitments. They're laser-focused on cost optimization and securing long-term earnings, prioritizing efficiency and shareholder value. And an important recent change reinforcing the strategy is the appointment of Anul Azhar bin Anil Jamal.
New board member.
Yes, as an independent non-executive director, started September 2nd, 2025. He brings over 40 years of unparalleled O&G industry experience. Global leadership at Schlumberger, chaired Petronas' audit committee,
Wow, serious experience.
Yeah, it significantly strengthens the board's expertise and governance. Perfectly aligns with management's prudent, shareholder-focused approach.
Okay, time for the deep dive financial scorecard.
Yeah.
After all that analysis on a scale of 1 to 10, how does Valesto stack up?
Right, the scorecard. After a comprehensive review, I'd give Valesto an overall financial scorecard of 6 out of 10.
6 out of 10. Okay.
Yeah, it truly is a mixed picture. Reflects both strong foundations and those current headwinds we've been discussing. So, breaking it down, profitability, revenue, net profit, EPS scores 410.
Ouch, 4.
Yeah, a 410 here signals a critical operational challenge. Despite their market dominance, they're currently struggling to translate activity into robust earnings. Those significant year-over-year declines in top and bottom lines for Q2 and the first half. Major concern. Even with some Q1 offsets, it's a fundamental test of their cost management and demand generation in a tougher market. Next, solvency and liquidity, debt, cash, liabilities, scores 810.
Much better there, 8.
This is where they really shine. An 810 reflects excellent financial discipline, substantial debt reduction, balance sheet optimization, great work there. However, it's not a perfect 10 because, as we noted, the recent decrease in cash balances and that negative net cash movement, they do represent a notable weakness that needs watching. Then dividend policy and sustainability scores 810.
8 again. Strong on dividends.
Another strong score. There's a clear stated commitment to increasing dividends, that strong institutional backing from PNB, and limited capital expenditure which frees up cash for payouts. The projected 12.5% yield for FY2025 is substantial. The main weakness here is that the sources don't explicitly state a specific payout ratio, and long-term sustainability is ultimately tied to future profitability and cash flow, which, as we've seen, have shown recent declines. Next, operational efficiency scores 410.
Back down to 4, tied to that utilization drop.
Exactly. This 410 is a major red flag. The drastic fall in rig utilization from 98% down to 57% indicates a significant reduction in their core business activity. Higher ADCR helps, sure, but it clearly doesn't fully compensate for this drop. Improving utilization is absolutely paramount. And finally, capital management and future outlook scores 7 and
7. Okay, bit more positive.
At 710, this reflects a balanced view. Their robust RM1.2 billion order book, disciplined capital spending, relative insensitivity to oil prices, those are strong points. However, the long-term risk of potential underinvestment leading to an aging asset base, combined with the inherent cyclical nature of the industry, that tempers the overall positive outlook a bit.
That's a very clear breakdown, thank you. Let's focus specifically on dividends for a moment. Velesto has this clear commitment to increasing payouts, you said. But can they truly continue to deliver at these projected levels, especially given some of those financial headwinds you've highlighted, like the cash flow situation?
Yeah, the stated policy is indeed to prioritize maximizing shareholder returns and returning free cash flow. For 2024, they had roughly a 7% dividend yield, and we're seeing these projections for a bumper dividend for FY 2025 at that impressive 12.5% yield based on a 20-cent share price.
Those of a 0.5% is big.
It is. And there's even talk of 3 cents per share in 2026-27. And it's not just talk, right? Their first dividend payment for 2025 was already 3 times higher than the previous year's initial payout. This strong commitment is largely driven by those capital reduction exercises, PNB's institutional encouragement for payouts, and their limited CapEx plans, which free up cash. So while we don't have a specific payout ratio stated, the intent to distribute is very clear. However, and this is the big but, the risks to the sustainability are significant. The declining rig utilization, the drops in revenue and net profit, the decreased free cash flow, that negative net movement in cash from operations, all of that puts pressure on their ability to maintain increasing dividends consistently.
Right, the desire's there, but the operational cash needs to support it.
Exactly. The cyclical nature of the industry, potential long-term asset aging from underinvestment, those are crucial factors too. So while the commitment is definitely there, their operational performance absolutely needs to improve to truly support those increasing payouts long-term. It's a key tension in their story right now.
That tension is very clear. So for you, the listener, what are the key challenges and perhaps red flags that you should be particularly aware of when looking at Velesto?
Okay, key things to watch. Firstly, that significant decline in rig utilization. The drastic fall from 98% to 57% in Q2 FY 2025 is a major operational red flag. Signals a sharp reduction in core business activity, hits the top line. Secondly, look at the subdued share price and investor wariness. The share price has been relatively flat. Investors generally remain wary of the broader O&G sector. reflects market skepticism. Thirdly, the declining revenue and net profit. These are clear financial red flags. Year-over-year drops point to challenges in earnings sustainability. Pretty straightforward. Fourth is the negative net movement in cash. The fact that the company's burning through cash faster than it's generating it from operations, that's a concerning trend for long-term stability and, as we just discussed, for dividend sustainability. And finally, that privatization uncertainty. The potential for PMBs often to be unexciting, introduces significant risk regarding your potential exit valuation, could force an involuntary decision at a potentially low price.
Okay, that's a lot to consider on the downside. Definitely some flashing yellow lights there. But looking ahead, what are the top 5 catalysts for Velesto in the next 2 years or so? What could really swing the pendulum, both positively and negatively?
Right, let's break those down on the upside catalysts. Number 1. Successful new contract wins. They're actively bidding for RM 4.3 billion worth of jobs. Securing these could significantly boost utilization rates. Rigs like Nagy 5, 4, and 8 already have contracts into 2026-2027. 2. Sustained higher average daily charter rates, ADCR. Their ability to command higher rates, like that USD 123K we saw, provides a strong buffer, could continue to offset utilization dips, shows pricing power. 3. Unforeseen oil price hike. Not something to bet the farm on, but a significant unexpected rise in global oil prices would definitely encourage majors to increase spending, benefiting Valesto's demand.
Always a possibility in that sector.
Always. 4. Reversal of rig utilization trend. With Nagy 3 getting maintenance done, new contracts in the pipeline, any improvement from the current low utilization rate could surprise positively, dramatically impacting financials. And 5. Strategic mergers and acquisitions. Their balance sheet's been prepped for future strategic moves. A well-executed M&A deal could unlock significant value, maybe broaden their services. Now, for the downside catalysts. 1. Unattractive PNB privatization offer. If PNB's offer is indeed unexciting, it could force an exit for minority shareholders at a suboptimal price. A forced sale, basically. 2. Continued low rig utilization. If current low rates persist or even decline further, it will continue to severely impact revenue, profit, cash generation. Obvious, but critical. 3. Prolonged oil price volatility and industry downturn. Despite Valesto's relative insensitivity, a sustained challenging O&G outlook could lead to further project deferrals, reduced client spending across the board. 4. Aging asset base. That current low capex, while good for cash flow now, could lead to an aging fleet long-term, eroding their competitive advantage against newer rigs. The long-term trade-off.
Exactly. And 5. Continued negative cash flow trends. Sustained negative net movement in cash, decreasing free cash flow, that could ultimately threaten their ability to maintain those anticipated dividend payouts, puts pressure on their core shareholder commitment.
So there you have it, a deep dive into Velesto Energy, a company showing, well, strong financial resilience in some areas, a clear commitment to shareholder returns, even as it navigates some very significant operational headwinds.
That's right. Despite the current dips in operational performance and profitability, Valesto's structural strengths, its market dominance, strategic discipline management, they really do position it uniquely within this challenging oil and gas services sector. Which raises an interesting final thought for you to mull over. Despite the current operational dips, with that strong order book and strategic financial management, could Valesto truly be setting itself up for a future where it's not super sensitive to oil prices? Nature becomes its biggest asset, allowing it to thrive against the industry's inherent cyclicality. Or will those broader headwinds ultimately prove too strong to overcome? Something to think about. That's all for this deep dive. We hope this has given you a clearer, more informed perspective on Velesto Energy. Don't forget to click that like button, leave your comments below with your own insights or questions. We do read them, and subscribe to our YouTube channel for more deep dives into the topics that matter to you. We'll see you next time.